Silver just moved from $30 to $121 in a matter of weeks, then collapsed 35% in days. This wasn't speculation running wild. This was coordination meeting resistance, and the timing tells you everything about who was positioning and who got caught. December 2025, silver sat at $30 an ounce, not because fundamentals supported it, because physical demand had been building quietly for 6 consecutive years of supply deficit, while paper markets held price suppression in place. And then in January, something shifted. Asian retail markets, primarily India and China, began accumulating at scale, not gradually, aggressively. The rally wasn't driven by Western institutional flow. It was driven by populations that understand currency debasement as lived experience, not theory. Silver hit $121.64 all-time high, 147% gain in less than 2 months. That's not a bull market. That's a structural imbalance being exploited before the window closes. But the rally had a weakness. It wasn't supported by Western central banks. Gold gets official sector accumulation, silver doesn't. That asymmetry matters when liquidity tightens. February brought the reversal. Kevin Warsh, nominated as Fed chair. Dollar strength spiked immediately, not because Warsh changes monetary reality, but because his nomination signals a specific type of policy regime. Markets front-run the regime, not the man. Then U.S. inflation data printed 0.2% against expectations of 0.3%. Lower inflation gives the Fed room to hold rates higher for longer without political blowback. That's a dollar bid. Silver sold off from $120 to $77 in days. But the crash wasn't just about macro triggers. The Section 232 tariff investigation on silver imports concluded with no tariffs imposed. That sounds like relief. It's actually permission for continued inflows that suppress domestic price support. Meanwhile, the London physical market had been experiencing a squeeze, tight supply, rising premiums, delivery stress. When price hit 120, that squeeze unwound. The holders who had been waiting for exit, liquidity, found it. They sold into strength. Then their silver demand from photovoltaic panels represents 30% of panel production cost at $120 an ounce. That cost becomes prohibitive. Substitution pressure builds. Manufacturers begin testing alternatives. Thrifting technology accelerates. The higher the price, the faster the industry moves away from dependency. That's not bearish sentiment. That's structural demand destruction in real time. Exchange-traded funds didn't follow the rally with inflows. They saw outflows. Retail wasn't buying paper silver at all-time highs. They were buying physical or staying out. Institutional money that moves through ETFs wasn't convinced. And that tells you the rally was driven by physical offtake, not financialization. When physical buyers step back, there's no secondary bid to stabilize. JP Morgan forecasts $81 average for 2026. Trading Economics sees 91 in 12 months. These aren't predictions, they're models, built on mean reversion assumptions in a market that just proved it can dislocate violently in both directions. The gold to silver ratio currently sits at 65 to 1. Historically, it trades closer to 80 to 1, and that suggests either gold is undervalued relative to silver, or silver is still overextended relative to its monetary peer. Short-term, expect continued volatility between $75 and $85. Support has formed at the 75 to 77 level, where profit-taking exhausted and bargain hunters re-entered. Medium-term, fundamentals remain constructive. Supply deficit is real. Industrial demand from green energy, electronics, and medical applications isn't speculative, it's structural, but without central bank accumulation and with substitution. Risk rising, silver lacks the institutional anchor that gold has. Long-term positioning requires understanding that silver is not gold. It's not a pure monetary asset. It's a hybrid industrial monetary commodity that responds to different forces. Simultaneously, when those forces align, you get parabolic moves. When they diverge, you get crashes. The current price isn't cheap by historical standards, but it's not expensive relative to the supply-demand imbalance. The question isn't whether to hold silver, it's whether you're positioned for volatility or caught by it. Dollar cost averaging absorbs volatility, lump sum entries amplify it. Know which strategy matches your conviction. Because the next move won't wait for clarity. Silver sits at $77 as of February 16, 2026. That's down 35% from the 120 peak hit in January. But the year-over-year number still reads plus 162%. This isn't a collapse. It's a correction inside a structural shift that most of the market still doesn't understand. The timeline matters. Silver averaged $35 through 2025. By early January 2026, it hit 121.64. Now it's pulled back to 77. The move wasn't driven by speculation alone. It was driven by a supply deficit that has persisted for 6 consecutive years, between 100 and 250 million ounces short every year. Mine supply sits around 850 million ounces annually, and it doesn't respond to price the way theory suggests it should. Scrap supply has increased during the rally, but not enough to close the gap. On the demand side, industrial use accounts for 60%. Solar alone pulls 200 million ounces, but that demand is now threatened by substitution as prices remain elevated. Investment demand split during the rally, but Asian retail buyers were aggressive, Western ETFs saw outflows, and that divergence tells you who believes in the structural story and who still treats silver as a trading vehicle. What happened in London and on COMEX during the peak wasn't just momentum, it was tightness. Physical market constraints began showing up in spreads, delays, and positioning shifts. The kind of pressure that doesn't appear in headlines but shows up in execution costs and available inventory. When that pressure eased, price corrected, but the underlying deficit didn't. The macro backdrop shifted as well. The dollar index moved, Fed rate cut expectations were repriced, inflation data came in mixed, and the interpretation of that data became more important than the data itself. So tariff policy under Section 232 created uncertainty, then partial resolution. Gold moved with its own logic, but the gold-silver ratio technical signals mattered more than most realized. When gold consolidates, silver either overreacts or finds its own floor. Right now, it's testing that floor. Technical levels are clear. Support sits at 75, 70, and 65. Resistance builds at 85, 90, and 100. RSI and MACD are resetting, but they're not giving a directional signal yet. Moving averages are starting to compress. That compression either leads to a breakout or a breakdown, and the catalyst won't be sentiment. It will be either renewed physical tightness or demand destruction from sustained high prices. 3 scenarios are on the table. The bear case assumes demand destruction, accelerates, substitution gains traction in industrial applications, and price settles between 65 and 70 pronts. The base case assumes consolidation between 75 and 85 as the market digests the rally and waits for the next catalyst. The bull case assumes supply, stress reasserts itself, investment demand returns, and price tests 90 to 100 or higher. None of these are predictions. They're frameworks based on probability, structure, and observed behavior. The timeline ahead matters as much as the levels. First quarter 2026 is about stability or instability. Second quarter will clarify whether industrial demand holds or cracks. The second half of the year will reveal whether the deficit dynamic reasserts or whether higher prices finally bring enough supply response to matter. What's certain is that the structure underneath this market hasn't changed. The 6-year deficit is real. The inelastic supply response is real. The divergence between physical buyers and paper traders is real, and the repricing that began in 2025 isn't finished. It's paused. Silver just dropped 35% in a matter of weeks. Not gradually, not with warning signals most people could act on. Fast enough that by the time retail investors checked their portfolios, the damage was already structural. This wasn't a technical correction that respects support levels. This was liquidation disguised as profit-taking. And if you're wondering whether to buy, sell, or hold, the answer depends entirely on whether you understand what actually triggered this move and why the timing matters more than the price. 3 forces converged simultaneously. First, the rally from $30 to $120 wasn't driven by fundamentals catching up to reality. It was driven by speculation, layered on speculation, with leverage magnifying every uptick until the position became mathematically unstable. When an asset moves that far that fast, it doesn't matter if the thesis is correct. The structure itself becomes the vulnerability. Technical indicators weren't just overbought, they were screaming distribution. And the smart money was already rotating out, while retail was still celebrating new highs. Second, the dollar strengthened on 2 catalysts that couldn't have been more precisely timed. Kevin Warsh's nomination to the Fed signaled a return to hawkish credibility, and CPI data came in better than expected, which gave the dollar bulls exactly the confirmation they needed. Silver trades inverse to the DXY. When the dollar rallies hard, silver doesn't just fall, it collapses because the entire commodity complex reprices in real time. This wasn't a coincidence, this was coordination disguised as market reaction. Third, and this is where most analysis stops short, the fundamental narrative that held silver up started showing cracks. No tariffs were imposed. That removed the uncertainty premium. Solar substitution technologies accelerated faster than the beat market priced in, which means industrial demand isn't as inelastic as the bull case assumed, and ETF outflows weren't just profit-taking, they were institutional rotation, which tells you the big players aren't positioning for a rebound yet, they're waiting for confirmation that the bottom is in, and they have the capital to wait longer than most retail investors can stay solvent. So what does this mean if you're actually holding silver or considering a position? Now, if you're a short-term trader, this is volatility, and volatility is the only environment where asymmetric opportunities exist, but risk management isn't optional anymore. Position sizing, stop losses, and liquidity planning are the difference between capitalizing on chaos and becoming part of it. If you're a long-term investor, the fundamental case hasn't broken. The supply deficit is still structural. Industrial demand is still growing, and the 2026 consensus target of $81 per ounce assumes normalization, not euphoria. That's a conservative floor, not a ceiling. But long-term doesn't mean blind. It means you're buying structure, not sentiment. For first-time buyers, this is where the strategy diverges from the narrative. You don't need to catch the bottom, you need to avoid catching a falling knife. That means scaling in, not going all in. Dollar cost averaging isn't exciting, but it removes timing risk. And timing risk is what just killed 35% of the portfolio value for people who bought near the top. If you're more aggressive, set alerts at $75, $72, and $70. Those are the levels where support historically forms and where you can scale in with conviction rather than hope. So if you're cautious, and there's no weakness in being cautious right now, you wait for a confirmed bottom, you wait for bullish reversal signals, you wait for the market to prove it's done falling before you commit capital. Patience isn't indecision, it's discipline. The expert predictions are split, but not randomly. JP Morgan is calling for $81 per ounce as a 2026 average, which is conservative and assumes no major disruptions. Trading. Economics is projecting $91 by 2027, which builds in moderate industrial growth and continued monetary instability. Sprott Asset Management remains structurally bullish, but emphasizes that the path from here isn't linear. The disagreement isn't about direction, it's about velocity and volatility. Everyone expects silver to recover, no one is confident about when or how smoothly. What you watch now determines your reacting or positioning. The dollar index is the leading indicator. If DXY breaks higher, silver has further to fall. If it stalls or reverses, that's your signal. Fed policy signals matter, but not the headlines. The actual rate trajectory and the language around liquidity. Gold's price direction will lead silver, so if gold stabilizes, silver follows with a lag. Physical market premiums tell you whether supply is tightening despite the paper price drop. And solar industry developments will either validate or invalidate the substitution risk thesis. These aren't random variables, they're the mechanism through which capital flows are directed. The verdict isn't complicated, but it requires you to separate what you want to be true from what the structure is telling you. This correction was inevitable. The rally was unsustainable, but the long-term trend hasn't reversed. The system that makes silver a strategic hold hasn't changed. What's changed is the timeline and the entry point. If you're buying at better prices than 3 weeks ago. If you're holding through volatility, not collapse. If you're waiting for confirmation, not permission. The action plan depends on your risk tolerance, your time horizon, and whether you're positioned to withstand further drawdowns. If the bottom isn't in yet, the market doesn't care about your conviction. It cares about your liquidity and your patience. Make sure you have both.